Hey traders, Monday night. Today, Memorial Day. Happy Memorial Day, everyone. So the markets in the US were closed. The futures were open yesterday evening and this morning and now. And it looks like we're not retracing any of the greens that we got last week. As a recap, I'll do that in a second. But first, I started on this window right here on purpose. This week, we are all about deal or no deal with regards to the debt ceiling. It seems that now consensus that we won't default. It might be ugly getting into the deal itself, but everybody agrees that we shouldn't default. I told you it would be scary because it's never happened before and we should expect the unexpected. But it's near zero, not quite zero. So as long as it's not zero, we should leave that scenario on the table. But it won't bog us down. We do have a jobs report later this week. I believe it's on Friday, and a whole bunch of other stuff in between. So we know the fundamentals, they have not changed. We know the catalyst is still in front of us. That's the debt ceiling, but it looks like they want to get a deal done, so we shouldn't worry about the worst case scenario. Timing is not my concern. So let's talk levels. And I've been saying for weeks, it's my thesis is that we get to 4,500 in the S&P, which is up here, upper right-hand corner, before 3,500, which is down here. Which brings me to the point that I'm trying to make. We should use the charts to control our emotions, and I'm going to make you believe in the charts. So this here is the bottom of the pandemic, down the bottom right. And up here is the top of the pandemic reaction. And this here is exactly the halfway mark of that, which happens to be the breakout spot. You see that? So if they tell us it's the age of the artificial intelligence, it's the age of the machine for sure. And machines are predictable, but because they like to use math. So they have systems and rules they follow. This is one of them. So if we rally from point A to point B, we give back half. It looks like a disaster, but it's part of, quote, normal price action. So let's use that logic and continue to try to beat what the consensus is. And we have been. We have been more right than wrong about this than most other experts out there. So I'm going to zoom in. This is the same chart zooming in. This is a daily chart. Last week we made a lot of progress, and especially Friday. And we are challenging the recent failures, which have been beating but not quite beat the February fail, which has been extremely difficult, and we will immediately hit the August fail. So the Nasdaq has already done that, and they're way up here in relationship to that. The small caps are nowhere near that. They're still mired down here. So the numbers are still the same. The SPX, if they close above last week's close, if we do better than last week, they're in a breakout as well. And I would expect the IWM, the small caps, to be above 180.5 for itself to break out a little bit, but it's still nowhere near a breakout, so it just makes progress off the frickin' floor. You get the picture? We have like 3 different markets. The S&P, this guy, trying to break out. The QQQ, which is, whoops, QQQ. Okay, one more time. Which is already in a breakout from its February high right there and August high. And they're up into the May and April high of last year, which were pretty incredible. So these guys are gone to the moon. The S&P are trying to get on board, to get out of the stratosphere. Meanwhile, a basket of 2,000 stocks, the IWM, stuck in the bottom. This is the high watermark that they placed last week. It used to be 180, now it's 180.5. If they take this out, they could spring up to here. So if they break out from last week's high, they might get another 5% on top of it. This is the big picture in the stock market. So how do I trade this? Well, it depends on my goals. I personally like to swing trade 3 weeks, 4 weeks, 2 months. I continue doing what I'm doing. I go long stocks that fall hard on earnings, hopefully. And I try to trade intraday using SPX and SPY. What is difficult to do is to buy calls, for example, and wait for a breakout, or buy puts and wait for a breakdown. Although if you bought calls in the last week or so, you did well because of the rallies. And I am holding some calls in the IWM, hoping that if my scenario of 4,500 SPX comes true or starts, then the IWM might have a catch-up rally. So far, those calls are a little bit red. I have about 10 to 14 days on those clocks. I'll see what I'll do with them this week. Meanwhile, you saw what I'm sharing. I'm long a bunch of stocks by selling puts and put spreads. These are bullish positions that do not require rallies. So as long as the S&P, like if I choose the SPX, is holding this ascending trend, see how they're buying dips, I'm sure to make money off of all these trades. I have a couple in trouble, like SE and PayPal, but let's see how they come out. Again, the good news, I don't need a rally to win. If I own shares and stocks, I can ride them. But if those shares made extreme highs, I might be tempted to take some off the table. Like the NVDA move is amazing, astonishing. Yes, they do have an extremely bright future. Management just set the bar so high for a year from now that I'm skeptical that they won't disappoint. Not in delivering. They'll deliver quality, they'll deliver growth, but they've shrunk 2 quarters in a row, and they promised like a growth of 40% by the beginning of next year, like the second quarter of next year. That's a lot of promises. What if they come out next week and those who are buying into those promises say, "To hell with it, you promised us the moon and you gave us a little bit less than the moon." So the results might stay good and disappoint feelings. I'm just saying, if I was long stocks that have been super spiky, I would take some off the table or sell some covered calls against them to make it work. You have to be smart. And the risk is that you will end up getting out of your longs, which is fine with me. So that's what I would do with stocks. If a stock dips a little bit, I'm not adding. And if I see a stock that's running out of control, I'm not chasing. For example, as much as I like NVIDIA, you couldn't convince me to start a new position as an investment for the long term up here. I have never in my entire life seen this kind of a chart as a starting point that ends well in the next, 3 to 4 months. If you have, let me know. We can discuss that in the comment. Not ragging on NVIDIA, but this is a perfect example of extreme exuberance. And if I buy into it right now, that's probably they should put my picture in the FOMO. It's not to say I can't make money as an investor, but this works for momentum buyers. They buy high and sell higher. That works, but they're usually active traders. So there's nothing earth-shattering. I expected the breakout, and it's been dragging forever, and now it's finally almost here on the S&P. Let's see if they can go through it. This week, I don't know the dates, maybe in the middle of the week, we're expecting some progress report on the debt ceiling. They might be trying to disappoint, and I would be looking to buy dips, disappointments. The only one I wouldn't buy is the actual break of the economy when they say, oh, we don't have a deal and we're going to default on our debt. I think that's a near impossibility. It is a definite improbability. So until that, because of that, I will be buying dips. Not every red tick, not every dip dips into good levels of support. When in doubt, just ask.